Everyone, welcome to another episode of the Truth About Real Estate Investing show. My name is Erwin Cito. I hope, is everyone enjoying the kids being back at virtual school following March break in April? Yeah, these are weird times. Since we moved homes before the break started, my kids switched schools. Our new school is only 5 minutes away by walk. That was part of our decision to buy a new house near school. Less than 5 minute walk. Versus our kids were taking the bus to school when we lived in Burlington. The biggest downside of busing kids to school, in my opinion, is it limits my face-to-face time with our teachers. So I'm not able to get feedback. I'm not able to say hello. I'm not able, again, this small feedback. Don't have nearly as much communication as we used to have with our daycare teachers, versus our kids that bus to school now. But now the kids are in virtual school anyway, with new teachers and new classmates, and it was their choice. Their former teachers are actually happy to have the kids come back and continue their classes, but the kids chose to move on. Pretty impressive. Normally the usually new is not welcome. Change is usually not welcome. I'm actually impressed that they're doing this. And the kids are doing quite well in virtual class like they did before lockdown. I have no idea why, but I wonder if it's because we really limit our kids' screen time. They do have a crappy tablet. We paid I think it was a throw-in for some sort of special that we got when we got new phones. But the kids only are allowed to use the tablet for audiobooks. We use Audible, and they absolutely love it. At least they're not looking at something and they're able to use their imaginations. We do play video games a little bit on the weekend. We have a Nintendo Switch. We play Mario Kart and Overcooked. So for anyone who knows Overcooked, there's lots of yelling involved. we don't play for very long, and we almost don't do any movies, as the kids don't really have that much time between. They get math and English tutoring 3 times a week, and they're in kickboxing 4 times per week, and also they just love to be outdoors. They're actually in our pool. We have a pool in our backyard. That was one of the niceties that came with their new house. They're in it right now. It's only the second time they've been in the pool for the last 3 weeks or so. That's when we opened it. We opened up the pool at the beginning of April, and I may jump in after recording this. I am now learning how to be a pool owner. Yesterday, I literally taste tested the water. The water was already filled. We bought the house with the pool already filled with water, and I don't know what else. And then, based on my taste testing skills, I proceeded to dump 2 bags of salt in the pool. I hope that does it, as I don't have a fancy saltwater testing kit, and I don't want to intentionally taste test the water again. Hopefully, the kids haven't grown another arm or other limb yet. The gas heater is cranked to 85 degrees, I think today's high was about 15, so hopefully I don't freeze to death. Today is also 48 hours after I've had my AstraZeneca vaccine. Today, also Justin Trudeau, politics aside, got his first AstraZeneca shot as well. Hopefully what's good enough for the Prime Minister is good enough. And also Chancellor of Germany, Angela Merkel, is good enough for a regular Joe like myself. Angela Merkel, the leader of Germany, has already had her second shot. In my experience, I've had basically 0 side effects. I actually set a personal record last night while riding my indoor Peloton bike for over 90 minutes. So for me, I'm feeling grateful. I'd like to practice a lot of gratitude. I think that helps with my mental health, as I know many are not so lucky with this virus, including my friends that are on the front lines in the hospitals. And I've gotten several messages, people asking me how I got my appointment, and they're disappointed in not being able to get their own appointment. So I do believe we are in this together, and I'll continue to do my part. I'll stay out of the hospital, heeding the warnings of ER doctors to avoid ERs, as if anyone ever needed to be advised to not do the stuff that would lead to going to an ER emergency room. I tip 15% each time I order takeout. I'll tip restaurants directly when I'm ordering on Uber Eats, and I tip the driver as well. I'll continue to do my charity work, and I'll bring value to our investor community. Speaking of value, we shot a video just yesterday that would be posted to my YouTube channel. If you didn't know, this show is also posted to YouTube. Only now are we actually going to start doing more video. But I actually did a separate video on my YouTube channel, The Truth About Real Estate Investing Show, on my thoughts about the 2021 federal budget. Why is it important to know what's in the budget? Well, the Ontario government in 2017 tanked the real estate market with the Fair Housing Plan. So I would want to know as an investor what's in the budget, and if I think there's anything in there that's going to tank the market, which I summarize for the Canadian real estate investor. For anyone who'd like to learn more about real estate in depth, we do have our May 15th monthly IWIN meeting. It's coming up with planned presentations on how to buy foreign vacation property. And we have a second presentation, how to make the interest expense on your home tax deductible. Everyone who's on my email newsletter is invited. The public is invited. All proceeds are donated to charity, and it's available for sign up at www.truthaboutrealestateinvesting.ca. If you just put your name and email in the right side, then you get notification of when this podcast is available. You'll be notified when we have events. Again, it's www.truthaboutrealestateinvesting.ca. On to this week's show. This week we have returning guest and Shane Melanson, who is one of the most active commercial real estate investors I know personally. He's pretty big time. He's been invested personally in hundreds of units, of apartment units. He's developed tens of thousands of square feet of commercial industrial properties, and now he's involved in skilled nursing facilities. I know I haven't heard of this either. Shane is just doing this for the first time. He's got a property tied up. So skilled nursing facilities is kind of like a less urgent hospital. So the operating costs are much less than hospitals. So that's what Shane's getting into. So Shane is here today to share lessons from investing during the crash, during this most recent crash. Shane was also an investor in the 2007-2008 crash, and also he shares today about the properties that he picked up back in 2008. He's sharing how he structures these multi-million-dollar development projects, because it's not all his own money. He has to go out and raise capital from other sources. He needs to raise debt, mortgages. So Shane actually shares the difference in getting commercial lending, commercial mortgages in Canada versus U.S. because some of his projects are actually in the U.S. So we do cover a ton of stuff. Hope to have those pens ready for anyone who likes to geek out on commercial real estate like I do. I like to geek out on all things real estate. I hope you enjoy the show. I give you Shane Melanson. Hey Shane, what's keeping you busy these days?
Erwin, good to be here. Lots of new stuff on the go, and we can dive in wherever you want to go, whether it's new development, skilled nursing down in the U.S. Lots of some kind of interesting things since we last spoke.
Yeah, it's before we start recording, we're like catching up. Like, you've evolved a lot since we last talked. When we last talked, you were last on the show, I think early pandemic, actually. I think we were doing an early update in early pandemic. So it's been well over a year. I think we had 12 listeners at the time. We may have lost 2. So there's about 10 people. So, we maybe gained 4. So we're in about net 14, somewhere around there. So, so there's a lot of people on the show. Possibly the majority of the people who listen to the show don't know who you are yet.
Yeah.
So we're going to cover some of the old stuff, and also talk about where you've progressed since then. Because wow, sure. you're all over the map.
it makes
literally you're talking about U.S. now.
Well, okay, so
all right, so before we get there, let's go back to a bit of the beginning.
Sure.
As your real estate journey, and also so people can get a sense of your chops, because you're definitely one of the bigger commercial investors I know.
Sure. So I grew up in a small town. Both my parents were teachers, and at 19,
in Alberta?
In Alberta, yeah, Whitecourt, Alberta. So about 2 hours northwest of Edmonton. And
dude, that's far north.
It's definitely cold winters. We'll put it that way.
9 months of the year.
And it's a logging town. So back then it was a logging town. Now there's a little more oil and gas and whatnot. But anyways, both my parents teachers. And one of the things that I saw early on was they refinanced their home. when I was 19 and invested in an opportunity that they really thought was going to be, the thing that set them financially free, right? I mean, my dad had a big family. My mom comes from a big family, both out east in Cape Breton and the Maritimes there. And they looked at this as a way to kind of help out their family and brothers and sisters and parents and whatnot. But they didn't know what they were looking at in terms of the type of risk analysis and, certainly refinancing their house to put all their eggs in one basket that they didn't understand. I mean, in hindsight, it's easy to say that was kind of a foolish mistake. But when you're in the moment and you're seeing all these business people in Whitecourt investing in this one opportunity, you don't want to miss out because you don't want to be the one person that had the opportunity and it passed you over, so to speak. So that was kind of my introduction to investing. I was pretty young at the time. I put money in myself, everything I'd saved up that year. And, went to university. Once I graduated, started to get into kind of fixing and flipping homes and just learning the business of real estate. Got my real estate license, got my mortgage license, started working at Sun Life Financial as a commercial lender. And so that's kind of when I started to see commercial real estate. I still didn't understand how to buy it because most of our clients were pension funds and REITs and, big companies. But every once in a while, we would see, a couple of individuals that would come in and they weren't from a big company, right? They were just one or two guys. And what they were doing was syndicating real estate. So this is way before podcasts and YouTube, or maybe YouTube was around back then. But essentially what these guys were doing was they'd go out, they'd find a property, maybe $5 million, $10 million. And they had the expertise, right? So they would find the asset, put some money in themselves, and then go out and raise money from others. And that was kind of my first introduction into the concept of, hey, maybe I could do commercial real estate as well. But there was still kind of a big gap, right? Like, how do you actually find the properties and how do you actually find the people to raise the money from? And then, I mean, you know my story, but, for someone that maybe doesn't, in probably 2007, 2008, I started to work with my father-in-law. He was observing what I was doing in the residential world. And I was successful until I wasn't. And in about 2008, when the market turned, I was stuck with, land that I couldn't sell. I was stuck with some properties that started to come down in value. Right. When you're new in real estate and all you see is an up market. The game then was just get as many properties as you could, right? Because, every property was going up 3, 5, I mean, in some cases, 20% a year. But when the market turned, right. You end up getting jammed up. And so I went through a bit of a struggling time. And Andy basically said, look, come with me on a trip and let's go look at some properties in the US. Because back then he saw something that, a lot of people were probably nervous, but when you have been in the game for a long time, you actually look forward to when the market pulls back, right? So when people were scared, he was looking at this as a great opportunity. And I mean, the wealth that was created out of 750 units that we helped his family company acquire was tremendous. And then
wait. You bought how much? That in that period of time, you guys bought what?
So we bought 3 different Class A apartment buildings, and they range from 240 to 264 units. And they were, right around that $20 million range, anywhere from 80 to 85 a door. Between 2000.
Well, that's pricey back in that day. Was this a really nice neighborhood?
Well, they were Class A.
Class A,
so, yeah. So a lot of these would have been, they were still. See, this is the thing. Like, the company that we were repping, they were not interested in C or B assets. They wanted quality real estate in great locations. Right. So we're talking about the Woodlands, Sugarland, North Dallas. And so they were okay to pay a little bit more, probably still in the 6 cap range. Wow. But when the market came back, first rents went up. And vacancies were always fairly low, especially in those kind of, there's a saying like there's a flight to quality when the market turns. And so these assets were always full for the most part, probably around 92% occupancy. And at the end of the day, when the cap rate started to compress and you had rents growing, I mean, they were 2 and 3xing their equity in a matter of 5 years. Not to mention the currency exchange. I mean, that's no one could expect that, but
Right.
yeah.
Yeah, because
So that was kind of like just learning the game and figuring it out. I mean, I probably toured, I don't know, 500 multifamily apartments, right? And we made offers on a lot. And what happened was probably in about 2011, 2012, when the market became a little more competitive, we started to get into bid situations. And now bid situations, especially in the US and even here in Canada, that's pretty commonplace. But back then it was difficult because, you'd bought some assets and you really, the program was to get to about 3,000 to 5,000. But now all of a sudden, the cap rates are getting squeezed, your margins are getting tighter, and, no one has a crystal ball. So in 2012, you don't know where the market's going to go. You can only kind of base your investment decisions on what you know today. I mean, in hindsight, we should have bought everything that we made offers on, but it just wasn't to be.
it was a scary time too.
Totally.
The financial system could have collapsed.
Yeah, that's right.
Right. And you were talking about Texas?
Yeah, that was mainly in Texas that we were involved in. We did a little bit of stuff in Phoenix, and then personally, Andy and I did some stuff in Palm Springs, and then we started to buy kind of across Canada.
Palm Springs sounds nice.
Yeah, we bought some homes off of a builder that was in trouble in Palm Springs. So,
did you keep any?
We didn't. We held on to them for a little while. And see, this is the thing when the market corrects. We bought in 2008, but the market slid for the next like 2 or 3 years, especially in single family.
Yeah, right.
So
and the States,
yeah. I mean, it came back and we did okay, but you learn something from every deal.
Right.
And there's certain things that I would do and wouldn't do again based on those.
Other than saying you should have bought everything you bid on, what other lessons were there?
Well, number one, when you're like for single family, we were buying on the basis that we were buying well below replacement, and we bought all cash.
Sorry, just to clarify for the listener, below replacement cost meaning you're paying less than it costs them to build it.
Yeah, exactly. So let's say it costs $200 a foot to build. We were buying these for $140 a foot. Okay.
Good return for the builder.
Yeah. Well, I mean, the builder was in trouble, so they just had to clean up their balance sheet, and there wasn't many buyers, right? So when you come in and buy 5 or 10 of these, you solve at least one problem for them.
Right. And then I just wanted to clarify for the listener. See, This is not always sunshine and roses.
Yeah, no, exactly. And, investors talk about price per square foot. That was one of the mistakes. But renters, they think of, okay, I can afford $2,000 a month. I can afford $1,800 a month. And so we were running some of our metrics based on rent per square foot. We were looking at things saying, okay, we're buying at, let's just say $140 a foot. I mean, this is back in 2008, so I don't remember all the numbers exactly, but I think that was kind of some of the numbers that we were looking at. And, we were still seeing comps at 190. So we thought we've got lots of room for the market to continue to deteriorate. And when it comes back, because these used to sell for $300 to $325, right? So we were buying it about 50% off, so to speak. But you don't know how long the market's going to take to come back. And in this situation, it probably took, I think we held those for 8 years. But for the first 4 years, it was, a lot of work. And the fact is we own them all cash. We had no debt. And anyways, so long story short, looking at those type of assets, we were not basing it off of cash flow. And that's one of the things that I like about commercial real estate is when we were buying the apartment buildings, for example, we knew exactly, okay, we're buying this at a 6 cap. So if you bought it all cash, it's going to generate a 6% return, right? But as soon as you put leverage on it, and as long as the debt is, usually about a 2% less than the cap rate, you've got positive leverage, or maybe, plus or minus. So going in, we knew, okay, our downside is this, and we stress tested, meaning we would say, okay, what if vacancy goes up by another 5%? What if rents fall another $50 a foot? Because in '09, no one was thinking or talking about rents going up $50, rents going up, right? It was like, how far can the market slide for us to be safe? And that's one of the things that I think, one of the big mistakes I'm seeing a lot of new investors today, especially when they're getting into these competitive bid situations. I mean, I literally just watched a webinar where a lady was trying to raise, $28 million or something. And I mean, it's her first project. And she kind of, like, someone asked, like, how many have you done? It's my first one, but I've got a really good team. And I'm thinking to myself, like, this is like a $70 million buy. And like, you're buying it, I think her pro forma was like a sub 5 cap, like a 4.5. And so the only way that you can pay a 6% return to your investors is if you're able to increase rents, right? But if you flip it and say, what happens if rents go down by $50 or $100? And what happens if vacancy goes from 98% or 96% down to 90%? Like, those properties are the ones that, unfortunately, it's the second or third person that comes in and buys it at a discount. They're the winners in these situations. And it's just having been in the game for long enough, you see when people that are seasoned, how they make money, and you see how the quote unquote newbies that come in and see everyone making money, and they come in late to the game, and they're just pushing prices. Not to say that it doesn't work, because for the past 4 years, people have done well from cap rate compression and whatnot, but it can catch up with you.
Very cool. And then I want the listener to understand a bit about your experience in commercial real estate beyond
Sure.
apartment buildings. Because last time we talked, we were talking about, like, I'm probably not saying this correctly, but you would buy vacant land and build retail and industrial and office spaces.
That's right.
Right?
Yeah. So we would do
quite a bit of square footage, not small projects. Like
yeah. Well, I mean, it's all relative, I suppose, right? Because like some of the developers that I'm aware of, and that I was out cat skiing with these guys. I mean, they look at what I'm doing, and it's kind of small potatoes, right? Because they might do,
maybe smart centers think you're small. Sure.
Yeah.
You're not building a Costco, right?
So you're right. We did 3 industrial buildings that were about 37,000 square feet. And we bought the land about 3 acres, just under. And one of the things that we did on that, and just if someone isn't aware, we were like, one of the big things I learned about the developments, the kind of 1,150 acres we did in Muskoka, so just north of you, was the importance of leasing and selling and verifying demand in the market. I think that's kind of one of my principles, if you will, is never to take something at face value or for granted. So what we did with the industrial is we gave ourselves 4 months of due diligence, right? So similar to when you go and buy a house, just think if the seller gives you 4 months to find a tenant and make sure that there's market demand. When you're doing 37,000 square feet and you're basically selling off of plans, because we didn't have anything tangible, right? It was basically, here it is on paper. So it took some time, took some selling, took some real effort, if you will. But long story short, it came together. We were about 75% pre-sold before we removed conditions, and by the time we actually closed on the land, we were 100% sold. So some developers might look at that, and say, well, Shane, you capped your upside. And that is true. But I am far more risk averse. And the difference between industrial and, say, multifamily, like, there's right now we're doing some multifamily, and I likely wouldn't do that because I'm not as nervous about where the market's going to be in 12, 18 months. In industrial, we have those buildings up in 6 months. So from start to finish, we were in and out of that deal in less than 16 months.
Wait,
So
you're taking a raw piece of land,
yeah,
and it's something that a tenant can move into in 6 months?
Yep.
Or at least a shell.
I will say, so it took about 5 months to get our DP in place, and then maybe another, so that's your development permit, and then maybe another 2 months to get your building permit. But as soon as you get your development permit, that's when you can start doing your foundation work, right? Because you get a partial permit to do your foundations. And it's incredible. Like the contractors, I mean, when you look at the buildings, because you're just building a shell, right? We didn't build out interiors. We put demising walls and obviously all the mechanical. But at the end of the day, we had, you know, from the time we kind of put a shovel in the ground, it was about 6 months, because I think we started in April and we turned over in November.
I'm sorry, Shane. We're going to probably have to keep you here for a while. How does the financing work for a deal like this?
Well, that's a big part of that was why we didn't build on spec or speculating, right? So what we did is we went direct to RBC, but I would say for the most part, if you are new to doing development or even commercial real estate, I come from commercial lending, right? So I understood that world. So we felt comfortable to go directly to the bank. But in most cases, you would probably use a mortgage broker that's going to understand the various programs that are out there. But because we hit our threshold, and I think our threshold with the bank was 65% pre-sales or pre-leasing, we were doing for sale. And essentially, you just put yourself in the bank's shoes, right? So the bank says, okay, you're going to put 30% equity, plus or minus, right? So we bought the land outright, and we had some of our soft costs that we front loaded. So, so the bank's saying, okay, so then we're going to lend you, let's just say it's $6 million in this. It was more than that, but plus or minus. And so the bank says, okay, if you get 65% pre-sales, then we're out of the deal, right? And then my equity is the next at risk. And that's probably the next 20%. And so what happens is it's really the last 15% is where all your margin is. And so for a lot of developers, they'll even say it's, you know, they don't make money until they sell out that last little bit. So if you hold on to 5 or 10% that you can't sell, that's where you can, you know, your profits get delayed. And one of the things, you know, knowing that, I told our agents that were selling these, I said, oversell it by 125%, get me backup offers, because I'd never, you never know if someone's going to back out of a deal. And we had some people come back and try to grind us on price or try to back out. And so we just had backup offers. I mean, it's just essentially, you know, putting yourself in the best situation. When there's more demand than supply, you're in the driver's seat. But if you're scrambling around and you're at 88% and you're just like, you know, you can't sell, now all of a sudden, because there was a development right behind us, and they had a bit of a different product in terms of not as usable. They started 6 months earlier, and a year later they were still trying to sell. And so, I mean, that's, and they, you know, they had a bit of a different debt structure and equity capital stack, if you want to call it that, in terms of how they brought money in. They tried to do it without outside investors. And there's good and bad to that, right? But because their project delayed, you know, I'm doubtful they were profitable. I don't know all the numbers, but I just, you know, I can figure it out on my own, and right. I think that they probably didn't do nearly as well as they thought they were going to.
Well, obviously, a lot more risk and a headache.
Absolutely, yeah.
Crazy. I don't even know where to go next. So how do you structure this? So was this all your own money, or did you raise the money, raise the equity?
We had about 15 investors. And
15? Wow.
So we would do what's called a syndication. And my partner and I put in, I don't know, 10 to 15% of the equity. And then we'd raise the balance from our investors. And, you know, a lot of these individuals have been with us for 10 plus years, right? And so they've seen a track record. There's a lot of trust. And obviously you still have to put together a business plan that makes sense. But I mean, I'm trying to think of a good example. One of the things that we did, I think, really well on this was we went to our investors once the deal was what I call baked, right? If I came to you, Erwin, and I said, hey, I got 3 acres of raw land, and this is the plan. We think this is going to happen, right? And I show you all the, you know, fancy graphs and everything else. Well, people that have money, they're going to look at that and say, okay, well, what if you don't sell? What if the prices are lower? What if this? What, you know, there's like a million what ifs. But if I say, look, I've already got contracts and I've already got deposits in place, and I've already pre-sold 70% in the past 6 weeks, and we've already got, letters of intent for the other building. So here are the numbers. Okay, so the numbers are going to be whatever, 30% returns, 35% returns, and now it's basically like, do you want in or not? Right? There's way less questions. Really, the questions are: A, can you deliver this? Can you build it on time? And can you build it on budget? And so that was, where my partner really comes in, because he's got the construction experience. I'm learning it, but I wouldn't say that I'm an expert, contractor or developer.
Interesting. Okay, Shane, you're going to be here for 3 hours at least, because we got to dig into all this. There's just so much to unpack. Like, we still have to cover, like, what did you offer the equity partners?
Yeah.
Let's start with that. Can you
Sure.
touch on? So you mentioned syndication. Would this also be considered private equity, or is syndication the only way to refer to this?
I mean, I'm trying to think of
There's some sort of form of joint venture.
it's different than a joint venture, and so this kind of falls under like private securities, right, where they are illiquid, and we're going to family and friends and accredited high net worth investors. I'm not like a securities lawyer, and so I don't want to give any kind of information that might be taken out of context, but I'll just tell you how we did it. So we put together essentially an offering memorandum. It's not a full OM or offering memorandum, but that's probably what some people would be kind of familiar with. And we would go to our investors with our pitch deck or presentation, investor presentation, and we'd say, look, I'll use you as an example, right? So I'd say, Erwin, here's the opportunity. We're raising, for easy math, $3 million. And, it's probably going to be a 2-year play. And in exchange, if you put in, just say for this example, $100,000, we're going to give you an 8% preferred return. Okay. So that doesn't mean guaranteed. It just means the first 8% on an annualized basis, you're going to get that. Plus, I'm going to give you 75% of the upside. Okay. So, and Shane, as the general partner, here's how I get paid, right? I'm going to get paid up front for an acquisition fee, because I risked $45,000 to put this deal together, right? I've got architects, I've got due diligence, geotech, all the reports, and I'm coming to you with a deal that's ready to go, not with an idea. And you don't have to risk any money. If the deal doesn't come together, you're okay. It's my money that's on the line, so to speak. Plus, I sign on all the personal guarantees, so my house becomes collateral to the bank for the build. And then in exchange for that, I will get what's called a syndication fee, or putting the deal together, and I'll get 25% of the profit and upside. And because we were a developer on this, we took a project management fee. Now, if we weren't going to project management or manage it, we would probably have someone else, because a project manager is basically holding the general contractor accountable. All right. And I don't want to get into too much of the details, because I don't think many people are. I mean, some people might be doing developments and whatnot. But that's kind of the high level. And so investors look at it and say, okay, so my risk is the $100,000 that I put in. I'm not guaranteeing the loan. I have no other exposure, right? I mean, there's provisions in these agreements for cash calls. So you definitely want to be aware of that. And what does that actually look like? But that's essentially how these syndications, LPGP agreements are structured. Does that kind of make sense?
It's fascinating stuff.
Yeah, it's.
I'd love to dig into it, but I think we may have already lost a bunch of listeners. We may have lost 3 people.
Yeah.
Hey, folks, if anyone's interested in hearing more, just message in, and we can have Shane come back for another session or something. Or, we've had Shane come and speak at one of our past Iwan events. So that's like the time. That's like the proper medium and venue for a more in-depth presentation, because then at least we can have more visuals.
For sure. And
other than just looking at Shane.
Yeah.
He can have at least hey, maybe he could show us his pitch deck if he's that nice.
Sure. I'm pretty open book.
Amazing, Shane. Now, so before we get to the skilled nursing schools or whatever you're doing in the States, how is the Alberta market? How is where are you invested currently in Alberta?
So in Alberta, Calgary, and I've been looking in Red Deer and Edmonton as well.
Mhm.
But we just closed on some land to do kind of a multifamily development here in Calgary, close to a TOD or the transit-oriented development, and or what we call a LRT. I think in Toronto it's like your GO train.
Yeah, yeah.
So we're right
No,
at
we
one
don't
of
we
the
don't
spots.
quite have LRT yet. We're getting there.
Yeah.
We're getting there.
But yeah, that's that. Like especially on a
A much
development.
nicer streetcar, much longer streetcars, and they usually have their own dedicated rail and road, right? At least in Calgary they do. I don't think
Yes.
it's going to be that way here.
Yeah.
But yeah, kind of like streetcars.
Yeah.
Better.
Exactly. And yeah, so typically I try to invest as close to home. I mean, like I talked about Muskoka. One of the things that I learned about that, and even going to the US, like it sounds cool, right? To be able to travel and, you're meeting people and it, but at the end of the day, and yeah, you have a family and I've got a young family. It's, for me, I don't want to be away from my family more than 2 nights at a time, number one. And I don't want to be traveling more than once a month at max. Now, obviously, in the environment that we're in today,
Yeah.
that's not even a possibility.
Yeah, yeah.
But let's just, fast forward any deals I'm looking at. It's like either I got to be able to get there quickly, or I need to have people that are kind of boots on the ground that are in that market.
Mhm.
Because in Ontario, I was having to fly out, and I don't know the number of birthdays that I missed. Actually, it's my daughter's birthday today.
Happy birthday.
Yeah, thank you. I'll tell her. And yeah, like I mean, the reason that most people get into real estate investing is for time freedom and financial security, right? And so, it's easy to chase the money and say, I can make lots of money, but then you're losing the whole reason you got into it in the first place, which is your time freedom, right? If you're on a freaking plane all the time, that defeats the purpose. So some lessons I had to learn kind of the hard way.
Right, because just to for anyone who doesn't know, like Shane shared much more last time he was on the show about the Muskoka project. It was a trailer park, was it?
Basically, mobile home communities. They were land lease. Yeah.
And so that's not just a real estate investment, that's a business.
It is. And it kind of ties into what, I'm doing with these skilled nursing, because it's a business with real estate.
All right, we'll get to that.
Yeah, I know.
We'll get to that. I wanted because I'm a real estate geek. I don't personally invest in Alberta, but I would love to know what's going on the ground. That's what I love about the show and the opportunity to talk to investors who are on the ground. Like anyone can read what's in the news. I want to actually read So first of all, the news is generally general. They talk about averages. I think Shane's probably would qualify as being above average. So what's the landscape like investment wise? Like are your industrial, commercial, retail, any of that? Is that multifamily? Are they renting? What's the situation? What's the market like?
Yeah, so we sold on our industrial, and I've got a retail development right now. I started this retail development, I think probably when you and I met, right? So sometimes these projects take a little longer. We're still doing retail leasing at numbers that justify new construction. Okay, so in the $30 to $40 range per square foot. But once again, that development, we had an anchor tenant, and so that anchor tenant was publicly traded, $6 billion market cap. So we felt comfortable to buy the land and lend and lease to this group, right? So they lease about half the site. And so the other half the site, the spec, is all of our upside. And so we are now 75% pre-leased on that. We're breaking ground, like knock on wood, like this month, if the snow stops and the ground defrosts so that they can get a shovel in. But yeah, we're still doing deals, but it's just way slower and it takes a lot longer. Our tenants, cannabis, liquor, lube shops, gas stations. So for the most part, resistant or resilient to COVID. That wasn't, no one knew what was going to happen in 2018, right? I mean, we were going after daycares. We were going after, like Anytime Fitness and some of these other kind of tenants, because we, back then, looking at it, no one knew. And you kind of look at this covenant or Orange Theory or whatever it happens to be. Well, we were just fortunate for the most part that we didn't have that type of tenant roster, if you will. So, and now obviously we've pivoted big time to really, look at the horizon and say, who do we want in there? Who can pay the rent? Who has the covenant?
Mm-hmm.
So
Mm-hmm.
on that front, and now when I said multifamily, maybe it's multifamily from the perspective of the lender, but these are townhomes that we're building with suited basements. Okay, so we like this concept of separate entrances. We like the concept of, I guess, in the US, there's a big kind of push on this single family for rent, and that would be, probably a better description of what it is that we're doing. But we've got a commercial loan, and and the rents for this are, we're not building it on spec to sell them off. That is an exit strategy. We could sell off individual townhomes if we wanted, but this thing pencils out at a very reasonable return, just based on for rent.
Pretty cool.
Yeah.
Sorry, Shane, you're gonna be here for 4 hours. Did your anchor tenant sign pre-pandemic or post-pandemic?
Yeah, they were in there. So they signed pre-pandemic.
Oh.
And they opened, like, without exaggeration. I remember I was in San Diego at a conference, and I was like, COVID was really becoming an issue, right? It was like, okay, well, like, are we even going to get the city inspector out, because they have a grand opening on, let's call it March 18th, and the inspector's saying he doesn't feel comfortable going out. Like, I can't remember but it was like that.
It's
that
early,
was the
right?
timeline of
Everyone
when they took possession. Yeah, and it was a lot of uncertainty, but they did sign, and they've been an incredible tenant. They didn't come back and say we need rent relief or we need this. I mean, if they did, then we probably would have had to revisit with them. But when they opened, so the anchor tenant is a very big kind of gas station or gas provider, and they sublease to triple O's. So triple O's is quite big in BC. But when they opened, we heard that they had like a record-breaking month in terms of sales and whatnot. And so, just the location was so good, and the fact that it's the only one in Alberta that I'm aware of. So
what did Triple O sell?
They sell burgers and milkshakes and all that kind of stuff.
Oh, okay.
Yeah. So it's like, think of it like a gas bar that's 2,500 feet, and then you've got a quick service restaurant, QSR they call them, for 1,400 square feet with a drive-through, and yeah.
Right, because drive-throughs COVID friendly.
They're still open. Yep.
Yeah. Fast. No seating. Cool. So for the listener who's especially newer to commercial, what are some tenant profiles that don't do well versus the ones you are looking for?
Well, I mean, if you're in retail, and I think just my own belief system and values, if you will, I'm probably moving away from retail. Okay, because I really don't know what the future of retail looks like. It's just changing so quickly. You don't want to be going up against the Amazons of the world, because Bezos is just too damn smart and he's got too much money, right? And so if he wants to come into a market and disrupt it, he can. That's not to say that I think retail is going away. I don't. It's just harder for me to look an investor in the eye and say, here's what I think it's going to look like in 10 years. Okay. Right. I mean, I like grocery anchored. Certainly, like I said, like the gas station, cannabis, liquor, anywhere that is kind of dependent on a person needing to go to a physical store that is Amazon, e-commerce proof. What's the other thing?
I think you need all essential services too.
Yeah, exactly.
Essential retail that's allowed to open.
But
maybe that's the list of people should start with. Check the province. What's allowed to open?
Yeah. Just look at the list, right? In terms of how vulnerable you are, right? Like right now in Alberta, we're like I think it's like a level 1 lockdown or something like that, and so restaurants now are closed again, right? They're open, they're closed. I mean, these poor owners. I just feel so sorry for them, because I don't know how you keep staff. B, I don't know how you continue to operate with takeout and skip the dishes and all the rest of it, taking like a big chunk. We don't need to go down that road. But I would just say, by and large, I'm probably moving away from retail, even though 5 years ago that was kind of what a lot of Canadian investors quite liked. On the industrial side, I think that you're going to see a lot more what's called last mile or kind of distribution, where people still need goods delivered, right? And I'm trying to think of a good example, but I mean, just you can just kind of observe what the Staples and the Best Buys and some of these big brick and mortar stores are doing, and they're pushing you online because their retail space is expensive. When they can go into an industrial space, the taxes come down, less than half. Their rent is probably half to a third, and all they need is the ability to store a TV. And then, the consumer now is saying, I don't like, I'm probably going to do most of my research online, and I'd rather it just be it show up at my door, number one. But saving that, if I just order it and then I'll go in, look at it, yeah, that's the one I want, and take it home. I mean, that's I'm not the retail expert, but you're just seeing more and more of that, and I'm just an observer of what's going on. So I think industrial, and then obviously people need a place to live, so that's why you're seeing multifamily be it continues to grow in demand.
I think the best example of like the best curbside is IKEA.
Exactly.
Because you know how the store's designed. It's like I think it takes at least 15 minutes to walk from the entrance to the cashier.
Exactly.
Like if you go the path they want you to go, and that's before you take the time to pick out your stuff, if you pick it out correctly.
Yeah, exactly. Yeah.
And then you have to list it yourself. I think a friend of mine told me it was like $5 to pay for curbside pickup. You just pull up and they put it in your trunk.
Well, yeah, my wife's a designer, so she knows that system. She's got it down to a science. And I tell her I don't even want to go to IKEA because it's like that's
a hike
for me. Yeah.
And then again, like I was like, okay, where am I supposed to find my stuff?
Yeah.
Can I just buy this one that's already assembled? Oh man, I'd pay extra for that. Buy the one that's already assembled. Awesome. Again, Shane, we're gonna keep you here for 5 hours because I want to go on to now this newest venture because you said what is this nursing stuff?
Skilled nursing facilities. Yeah. So
this is like a school?
No, think of it like, and I kind of just got exposed to this myself, right? So there's swim lanes that I know, right? I know industrial, I know multi, I know retail, or at least I have partners that are kind of experts in it. And a gentleman that I met probably about 5 years ago at a conference, real estate conference, he and I stayed in touch, and he lives in Seattle, and we've been talking about the seniors assisted skilled nursing for that that duration, but we never really got kind of serious, if you will. And about 6 months ago, he called me up and said, look, we're putting this property under contract. My brother-in-law, he's an operator. Okay, so just for defining what a skilled nursing is in simple terms, in the US, let's say you go in for surgery or you have a procedure done at a hospital, you're not ready to go home, but it's expensive to keep you in the hospital. So I asked around and I've heard 1,500 plus a day, right, to be in a hospital. If you go to a skilled nursing, you still have a doctor on call, you have nurses, but it's privately run, and it might be anywhere from $250 to $600 a day. And in the US, that'll be covered typically under Medicare, Medicaid, HMOs, right? So the insurance companies like that because they're paying way less than keeping you in a hospital, right? And so the stays might be 2 weeks up to 2 months type of thing. And so you're typically going to see these next to major hospitals. And so it is a business, A, and B, it's actually very difficult to get a CON or certificate of need. And that means the state of Florida, or the state of California, or whatever it happens to be, they will determine how many skilled nursing facilities are required, right? Because they don't want people going out of business. So they try to keep it so that the facilities are full, but not so full, right? If everybody's at 100% and all, obviously COVID or something else happens and people need to, they need this type of care, then they need more beds, right? So the barriers to entry are very high. If you want to think about it like kind of what Warren Buffett talks about, like a moat, like when I started to get into this.
So sorry, just for listeners, about like a castle, the
Yes.
body of water like was around it to defend the castle, right? So
yeah. So this is
the business term, like you're protected because of the difficulty of getting a license to operate or a permit to build.
That's right. That's right. Yeah. Yeah. Just to be an operator is it's extremely difficult to get into that. And so it's a bit of a double-edged sword, right? Where you look at it and say, okay, well, if I need that high level of skill or to operate this type of a facility, you know that the competition is going to be a lot less. And B, you have to really make sure that you're working with someone that knows what they're doing. They've been in the game for a long, duration, if you will. And so this gentleman, he's been in the business for 25 years and he's been an operator, and he's now got the opportunity to acquire some of these facilities that he's operated for the gentleman that he's worked for. So the first one that we're doing is about 20 million bucks. And, I mean, if I told you the numbers, and I mean, if you want, I will. It's like I thought initially that they were mistaken because they're not commercial real estate guys. And so when they were telling me what the cap rate was, I'm like, no, that doesn't make any sense. Like that's not that's more than what a hotel would sell for, right? Like we're talking double-digit cap rates. And
can you share?
Yeah, like I mean, the one that we're looking at is like a 12% cap, which essentially means that if you're borrowing at, if you're borrowing at 3% money, right? Because you can get HUD financing, which is the equivalent of say CMHC, you're getting, more than 20% return. So your payback could be 3 to 5 years type of thing, and that's without any value add. So it took me a little while to really kind of get my head wrapped around it. But one of your comments earlier was like, because I do lots of different things. And for me, I'm always looking for opportunities, right? Like what are the skills that I have? Okay, I'm very good at raising capital. I'm really good at identifying properties that make sense, and whether that's, adding value. And the third one is finding people. Right? That's why I have a show. That's why I think you probably have a show too, right? It attracts people and you get to kind of filter through. And when you see a unique opportunity come up, I mean, I've been looking at doing senior assisted for 4 years, but it was so difficult to find an operator that made sense that I wanted to partner with. And so my eyes were open to it. And that's why when I came across this type of an opportunity, and it's like, where do you think the market's going? Where do you see the future? And so I'm looking at multifamily. Like I said, back in 2008 to 2012, it was kind of a blue ocean. Now it's red and it's very difficult. So I'll do developments because there's less competition in that world. Skilled nursing, I mean, I could talk about it till I'm blue in the face and give people exactly the program. I'm not the expert at it. I'm not going to pretend to be, but there's not going to be 50 podcasts that show up, in the next 2 years talking about skilled nursing, if you will, right? Because A, it's niche, and B, most people wouldn't even know where to start because it is highly operational and whatnot. So that's some of the reasons that I kind of got drawn into it, and it's very exciting.
How far away are you from starting a project?
Well, we're under contract. And so we'll likely close in July.
So you have a piece of land under contract? Like it's a empty lot, or you're tearing something down, or? Yeah,
sorry. So the skilled nursing we have under contract, that is in Florida. That is already built, right? So there's no development on that. That's an ongoing concern, if you will. The land that we're doing the townhomes, yes, we own that. And our architect, I talked to him yesterday, we're in for a development permit right now. There's an election coming up. So if you're a developer, just take that into consideration. Even though we have the land zoned and it's ready to go, there's, I don't know, not risk, but it just, there's what's called here in Calgary a DRC, or they basically have to, there's a review committee, right? And so they want to look at your plans, even though the zoning and everything else is permitted, they can still kind of delay your project. And so it's, it's just part of the game. And when you're a developer, you're a problem solver. So.
Yeah, we have those here too. We have LPAT here. I don't even remember what that stands for, but against a review panel. It's not
detailed
fun.
review committee, I think is what it's called, DRC. Whatever. There's so many acronyms.
No one looks forward to going to them.
No.
So this is going to be one of your new things then, because the business sounds viable. Like I think when you mentioned like $200 to $600 a night. For anyone who operates an Airbnb, like, that's fantastic numbers. Obviously, you have more labor involved, but you also
Absolutely.
have scale.
Yeah.
Right. Because you'll have staff, like not cheap staff either. You have elevators, you have parking, you have possibly underground parking, probably a whole bunch of liability.
Yeah. No. Absolutely. I mean, it's look. There's no. One of the phrases I heard someone say is there's no 20% T-bill, right? Like you don't get 20% with the risk of
for no risk.
So yeah, there is some risk for sure. And but it's all about mitigating it and understanding, right? And that's why having someone that's been in this business for the length of time that he has, with respect to, okay, here's our insurance for liability, and we just put X amount, because at any given time you might have a couple of lawsuits. Like that's just part of, and it's usually not even the individuals. It's just because the U.S. is so litigious. They just know, the lawyers know how to play the game, right? So it's like, okay, well, you just put this much money away every year, and this is how you settle out of court and go to arbitration, and and then this is how much you need for your staffing requirements. And even in COVID last year, which was their worst year, they still we're still basing those numbers, the offer, off of 2020 numbers, which were down significantly from any other year. And so we're being very conservative in our underwriting, saying that, hey, we think that when this, we don't know when it's going to get better, but we feel that at some point things will. And especially now that what I'm hearing is with all the vaccinations, life in the US has definitely gotten more normal, whatever that is now.
Yeah, I think I read that half of adults already have had at least one shot. That includes Johnson & Johnson, so they're done. They're good, right, for their first year or whatever it is.
Right.
Yeah, I'm gonna have to do a site visit with you. I haven't been to Florida in just over a year.
Yeah, well, you're closer too, so I'll let you know when the borders open up and you and I can travel. That'd be a lot of fun.
Awesome. What city is it in?
It's in Jacksonville.
Oh, I heard nice things about Jacksonville. Actually, any part of Florida is nice, really, in general. Now, why Jacksonville? Why Florida? Because I don't know. Because I follow a lot of people in business. For example, there's quite a bit of exodus from California. I have some friends from in the Vancouver area who are planning to move to Florida. Why Florida?
I mean, I like kind of the south. I think they call it the Panhandle, right? Like from Texas down to Florida. Certainly, I like going into states that are pro-business, low state taxes, and it just so happens that this state is quite favorable to own skilled nursing facilities. And so I think that there's maybe 4 other ones that we could potentially take down just from this one operator. At a certain point, you'll ask me questions and it'll be outside of my wheelhouse, but that's one of the drivers, if you will, is he's already there. He's set up. That's where his team is at. He's got about 350 people that report to him. This is the main gentleman. And what was I going to say? Sorry, my phone's just ringing here. Yeah, that's part of the allure, if you will. And I mean, you can see just the people kind of exiting out of New York, and there's In New York, they're going down to Florida. In California and Illinois, they're going to Arizona and Texas, if you will, right? So yeah, I just think that you're looking at states that are pro-business, right? Come to us, and you just want to be on the winning side of that move.
Very cool. And my next question. Oh, sorry. I want to ask about partnerships. Where's the division of duties with this partner? And I want to ask you about your construction partner as well. But
sure.
What's the division of duties with the operator of these skilled nursing
facilities?
I didn't want to use hospital because that's not the right term.
No. So the division of labor,
general use nursing home.
Yeah, yeah, you could probably kind of use that terminology. It's not. Yeah. I don't even think
no age requirement. It's just.
It's just fulfilling a need, right? There's therapy. There's lots of and different skilled nursing facilities will cater to various specialties too. Now, right. If we start going down that road, I'm not going to be able to answer the questions, but so. Yeah, and that's
division of duties.
Yeah, division of duties. Exactly. You gotta stay where you're comfortable. So the biggest things that I'm helping them with is the debt, right? So the past 2 weeks we've been on the phone with a couple different lenders in terms of securing our debt and making sure the terms make sense to us.
Right. Sorry, U.S. lenders? These are U.S. lenders? These are U.S.-based lenders? Right.
Yeah. So that's one. Number two would be on the raising capital. Like, how are we going to approach investors? What is the marketing plan, if you will? And so that is just something that I've done, and I understand how to have those conversations. You know, they sent me their first pitch deck, and I said, look, like it looks good. There's lots of kind of good things in here, but the reality is, A, it's way too long. B, it's confusing. And so let me go away. I'll redo it the way I would raise capital. And then when they saw that, they said, like, Shane, we could hire you as a consultant, or we could, whatever, get coached by you, but we'd rather have you in our deal. And so in exchange for a percentage of the deal, I'm basically walking them through. And this isn't like a one-off. This is something that, the plan is to kind of grow it and do multiple facilities, if you will. So it's really raising capital, getting the debt, and on an ongoing basis, it'll be on the acquisition side as well. So they can do the operations, and they field inbound inquiries. Like, here's one of the differences. So in multifamily right now, any seller for the most part is going to go to a broker, and they're going to go and say, list this and sell it for the most amount of money, and which generally means a bid situation. In skilled nursing, like, the field of people and prospective buyers is so small, number one, and there's not that many brokers that I'm even aware of that specialize in this. It's like the operators and owners are all connected, and they just call each other up. And so at any given time, Robert, the guy that I'm working with, I was talking to him 2 days ago, and he's like, yeah, I got 3 more people that want to sell their facilities to us. And either people, and there's just not that many buyers. I mean, there's hedge funds that are snapping these up like crazy for obvious reasons, but there's not that many independent individuals or groups like us that can do this. So that's one of the other kind of reasons that I like it. And they want to focus on their sweet spot, their wheelhouse, and they said, you can come in and really kind of help us execute on the business plan.
Mm-hmm. Fascinating stuff. So what's the difference between you raising debt in Canada versus trying to raise debt in the US?
Well, the biggest difference,
for listeners' benefit, we're talking about trying to get mortgages, trying to borrow money from banks.
Yeah.
Right.
So the biggest difference is, in the US, they typically have non-recourse loans, meaning you don't have to put up guarantees. Okay. Yeah, which is pretty big. Now, I say that, but there is a requirement for what are called the lie, cheat, and steal, or the carve-outs. So essentially, if you're, doing anything illegal, then you would be responsible or on the hook, right?
Right.
And typically, what's required is you need to have a balance sheet that supports the loan amount, right? And so sometimes what you'll do is you'll rent someone's balance sheet if you don't have $20 or $50 million or whatnot. And those are called key principals. So in Canada, you can go out and you can rent someone's balance sheet, no different, but that person would be on the hook. They would actually be guaranteeing that loan. In the US, it's really non-recourse. And so it's, a little bit easier to find people because there's less risk.
So even though you're Canadian, you're just having to rent someone's basically
Covenant.
their net worth, or their company's net worth to qualify for these mortgages.
Yeah. Now, my partners are in the U.S., so we've been able to kind of get around that. That's not really an issue for us, but you just kind of ask the question. So if you're a Canadian, like when I was going into the U.S. personally to go and buy properties, that was going to be a concern, right? The banks are saying, well, all your assets are in Canada. And so, we want someone that's local to, guarantee these lie, cheat, and steal.
Makes a lot of sense. And so a book I read recently, I don't know if you read it yet, Who Not How by Dan Sullivan.
Yeah.
Yeah. So what you're talking about is follows that beautifully. Like you have partners but you partner with people that have complementary skill sets.
Yes.
At what point did you decide to partner? Like, for example, the mistake I see a lot of entrepreneurs and real estate investors make is they try to do everything themselves. Like, oh, why would I give up anything part of the deal? If I do it all myself, I get to keep 100%.
That's right. And that's why they stay small.
Right. So you're saying then the opposite is true. If you want to scale, then you kind of need to work with other people.
I think in commercial real estate specifically, like in residential, it's a little more straightforward. But I mean, even with joint ventures, you see the people that are doing it at the biggest level, they're typically still finding others that have, it's been such a long time since I acquired, like a bunch of houses. But even when I was doing that, I found joint venture partners that could help out on getting the debt, right? Because, I could probably get 5 mortgages, but then if I wanted to get 20, I needed other people to help out with that. In commercial, there's a lot more moving parts, right? So you'll have the ability to execute, you'll have leasing, you'll have, in my case, if I'm doing development, operations. So there's different divisions of labor, like you kind of pointed out. And so if you know where you're strong, and what I noticed is finding deals and raising capital were the 2 areas that most people had the hardest time with. Either they had money, but they couldn't find deals, or they had deals, but they couldn't raise capital. And so I figured I'm going to master both of those, and I'm going to get extremely good at it. And so you think about the guys in Florida, well, they have amazing deal flow, but they don't have the capital. Okay, let's call Shane, let's bring him in, right? Some of the people here in Calgary, for example, the gentleman that I'm doing the townhouse with, he was a coaching client, and he actually had the ability I found the deal for him, and he had the money, but he was kind of like, look, I'd really like some support through the whole process. And so, because I've known him for a long time, I said, sure, like this is someone that I could, you're kind of getting into a marriage, if you will, right? Because you're going to be with that person for the next 2, 3, 5 years, however long that project is. So you got to be, pretty diligent on the type of people that you're going to partner with. And because I've had partnerships that didn't go as planned, I'm very cautious on really vetting the type of people that I want to do business with. And I would say one of the mistakes, I mean, you didn't ask this, but one of the mistakes and one of the things that I learned from my father-in-law, Andy, is it was kind of like I would get lawyers or accountants or people that had kind of technical expertise that wanted to partner with me, right? I can do all the accounting, Shane. I can do all the legal paperwork for a percentage of the deal. And I say, look, that's nice. But the reality is, I mean, I can pay you to do that, right? If you think about where the real value in this deal is, it is not creating the paperwork. It is not doing the financial statements at the end of the year. It is not, putting this LP structure together. It's finding the deal, raising capital, and operations. And so if you are not in one of those 3, at least in my opinion, then you're probably not going to be in the deal, right? Like that's, like I said, I mean, this isn't to say that that's the way other people should think. It's just the way I think. And it's kind of served me well.
Right. I think similar. Anyone you can pay a wage for, even if it's $500 an hour, it's potentially better. It's potentially cheaper to pay that than to give up equity.
Yep. And the people that charge by the hour, they usually have a different mindset too, right? They're looking at it. I mean, there's a lot of work that goes into a deal. I mean, I just had a, you know, $16 million deal that I worked on for 4 months and had to walk away from it. I mean, if you're a lawyer and you just spent $20,000 in billable hours on that deal, you know, you're like, you want to recoup that, right? But as an entrepreneur or an investor, you just have to look at that as a cost of doing business. It's like, yeah, you know
Sunk
what, we
cost.
put 25,000 bucks, you know,
You have to walk away at times.
yeah.
Yeah, I'm sure you've had deals where you during conditional period where you've done due diligence, did environmentals, and it didn't pass, and you got to walk
That's right.
away. You got to eat
That's
the
right.
cost.
Yeah.
That's the truth about real estate, folks. There ain't all sunshine and roses. There's
No,
actually some
no, no.
investment and losses.
People only want to talk about the successes and all the, you know, oh, you can make money overnight. And, you know, it's like, yeah, I mean, we could talk about some of the big successes, but the truth is it's minimizing the downside, and it's minimizing any type of losses that you have. That's the people that stay in the game for the long term.
Yes, because that's what keeps you go. That's what allows you to go through COVID or
The cycles.
2007 or an oil crash or right,
Absolutely.
because eventually they happen. Right, this is the second pandemic I know of. It does happen. It's just yeah, no one saw that coming. Shane, you've been so generous with your time. Oh, I wanted to ask you actually. So you mentioned coaching clients. So you do you still offer coaching?
Yeah, I still bring on clients every so often, as long as they're a right fit for investing in commercial real estate, and there's obviously alignment. I do that mainly because I want to make sure that if someone's going to move into this world of commercial real estate or multifamily or developments, that they've got someone that they can bounce ideas off of, that they can essentially bring a deal in. I mean, yesterday, one of the clients out in Toronto, actually, he showed me some land. And within 5 minutes, we were able to dissect it and say, you know what, don't waste any more time in this, because the price that they're asking doesn't make any sense.
Right.
So yeah, I do offer some coaching on that.
Fantastic. Oh, so and I wanted to bring up about coaching. Like coaching ranges from what I've seen, like 10,000 and 30,000. I've seen as high as $50,000 a year. And then I wonder, I don't know if the listener's wondering this, but I often wonder is at what point do you offer a coach or a partner part of the deal, and then how much?
Yeah, I mean that's such
Because
a,
you have that experience, no, where
yeah.
clients have asked you to be participate in the deal.
Yeah, and it's very selective, and I don't even talk about it because I don't want someone to come in thinking, oh, I'm just going to partner with Shane, because that would
Right.
be, you know, that just wouldn't be sincere, because that's my goal is not for someone to partner with me. That my goal is for them to be able to do their own deal on their own. But in some cases, for example, if it's like a $20 million deal and there's like a real runway to do something for the next 10 years. Like I probably wouldn't take on any more than 2 or 3 people that I would even consider doing that with. And there would have to be probably like a year of established relationship, right? Like you and I have gotten to know each other for a long time. I know your values, and you know, likely know a lot of my values. So that would, you know, you could envision something like that coming together. But if you're just having a conversation with someone and then 6 weeks later they're like, hey, well, let's partner up on this deal, that's probably not a path that I would advise on. I mean, you really, if you think about it, you're going to get into a business relationship, and everybody starts off with blue sky, but then it's like, okay, let's get into the money, let's get into the debt, let's get into covenant, let's look at your personal net worth, let's look at mine, let's look at, and pretty soon it's like, geez, like I don't think that this is, you know, this is what I thought it was going to be. And so, you know, you can spend 6 months and it just fizzles away because, you know, people just, if you have no context for what's involved, it's can be overwhelming.
It's like a marriage. Like what are people like on down days?
There you go. Yeah. Yeah. I mean, you know, just like it's easy to get dressed up and look, you know, pretty or you know, I don't have to do my hair anymore, but you know, like you can put your best face on for 3 hours, but go on a trip with someone for a week and see whether or not they, you know, you're right. see what happens when they get hungry, see what happens when something doesn't go the way they thought it was going to go. And you start to see, how people handle stress.
Right. That's actually a good point in general about when you're building your team as well. I've seen lots of people just jump into business relationships without really knowing the other party.
Yep.
Right. Without I've seen lots of people not even background check people.
Yeah.
Like it's funny because we both deal with a lot of landlords, so they'll background check tenants. They won't background check people on their team.
Partner
or like team, reference check.
It's very interesting, isn't it?
It is interesting, and that's the truth about real estate investing. There's a lot of dishonest people in the real estate industry.
Absolutely. Yeah.
Awesome, Shane. Shane, where can folks follow along in your journey?
I mean, the easiest is my website, just my name, Shane Melanson, MELANSON.com. And there, I mean, lots of resources, my book, my podcast, social media. I was going on Facebook and Instagram for a little while there on a kind of pretty consistent basis. But it's only when I have something that I think is of value, right? I don't want to just go on there, and share stuff that people won't find interesting. So, but if someone's interested, then those would be good places.
Excellent. And Shane, I like to ask guests to, because I talk a lot and I ask a lot of questions. So is there any final thoughts you'd like to give? Anything you'd like to share without me prompting?
I think just like an observation that I've seen and learned, and that is like the landscape and the world of real estate, whether it's residential or commercial, like it's constantly changing. And so I think that if a person wants to be competitive, you should really be on the cutting edge and looking at where do you think things are going to go. And so I've shared a lot of what I believe is going on. That doesn't necessarily mean that it's right? My paradigm is, because I'm in Calgary, right? You're in Toronto or in Hamilton. And so you see things from a different lens and perspective. So talking to people, plugging into these kind of podcasts, I think is a great idea. And then my biggest thing is, where do I find, like, how do I create value in a deal? And waiting for someone to bring me something has never been, I've never really found that to be a way to kind of get ahead. I've always tried to get right to the source. And if, there's kind of one principle is like, how do I see deals first? How do I get to be the first person to see that opportunity, whether it's from a seller or a broker, and then being, responsive as best I can in getting back to people so that they take me seriously. So.
Sorry, Shane, gonna keep you a little bit longer. So like you said, you want to be informed of opportunity. You want people to get back to you. How do you do that? Because there's going to be people who reach out to you, for example, after this show.
Yeah.
And the worst thing that people ask is like, do you mind if I pick your brain? Like just one, but that's it. That's the only thing in the email.
Yeah,
you respond to that? Is that good? Is that a good way to reach out?
No, I don't think so, because that means, can I get free consulting, right? And so to me, that's kind of a waste of time. I mean, it's got to be something that is mutually beneficial, right? And so if you're reaching out to someone, so if I reach out to someone, the fact that you have a podcast. So I'll give you a good example. I've got 2 clients right now that are trying to get into a different market, and they're like, Shane, how do I do that? Well, I gave them, 3. I sent them 1 email, and then I said, you know what? You guys have a huge YouTube following. Why don't you, whoever you want to reach out to, invite them onto your YouTube channel? Now you're giving something of value. You're exposing them, and they're far more apt to give you their attention and time because there's something in it for them, right? I mean, I had a gentleman, last week who I didn't even know who he was. He's like, hey, can I have you on my podcast? And I think he's, like a kid in his basement. And I said, sure. You know what I mean? But he led with like, hey, I can give Shane some exposure, right? Now, if he just said, hey, Shane, like, because I get people on LinkedIn all the time, hey, can I get 20 minutes, 30? Of course you want to help people, but our most precious resource is time, right? And so if it's like a one-to-one conversation, once that 20 minutes is up, it's gone and I never get it back. But you and I having this conversation right now, someone can tune into this 2 years, 3 years, 5 years from now. Maybe I'll regret saying some of the things I did in terms of, but it is what it is. And but at least it's leveraged. It's a leveraged form of communication. And so I think that that's kind of one way. And it's one of the reasons, like I learned it from you, right? I mean, like the whole reason I was in Toronto 2 years ago was to learn how to do a podcast. So I literally flew down, spent a bunch of money with Jay, who kind of showed me the road ahead, if you will. And do I make money from my podcast? No, but I've had incredible opportunities that I've never would have had exposure to if I didn't have that. I mean, I had you on my show, right? Like, so we've been able to develop more of a relationship because there's there's give and take, right? And so I think if people come into the conversation where it's like, how can I, like, okay, I know what Shane does, or I know what Erwin does, right? And I know what I want, but maybe I should lead with what is this person, how do I help them first, instead of how do I get something from them? That I don't know. That's simple,
Awesome.
but
Basic how to win friends and influence people.
yeah, exactly.
If you haven't read the book, please do. That's not to you. Sorry, that wasn't. I didn't say that to you.
No, I've got the book. I've read it.
I've actually make all my staff read it as well. Shane, thanks so much for your time. I know how busy you are and how much you bill an hour. So thanks again for doing this. If you mind, do you mind sticking around for a bit?
You bet.
Once I stop recording. All right. Thanks again, Shane.
Thank you.